Good evening, everyone. This is Tim Pike with some horrendous news. There is one last possible lecture in this class. Based upon the final averages, I decided to give a Test 4 Selected Questions lecture. This lecture is entirely online, and if you follow the instructions in this video, or at least the best that I can come up with, then you will have added to your final average grade 2 points. Not 2.1, not 2.3. There won't be additional rounding, but it will be worth 2 points. So if you have an 88 average at the moment, you still have the opportunity for an A if you follow the instructions in this video. We'll begin with the most often missed questions. They will be shown blank in front of you so that you do have to listen to the audio lecture. So question number 1, the answer is B. Certainly the answer is not A, because cash flows are not considered less important, and it certainly doesn't recognize on item C revenue when recognized but expenses when paid. So we need to definitely understand that the reason we do accrual accounting is because it provides more consistent basis for predicting cash flows, and that's really what it's about. Ultimately, we want to turn every asset into cash flows, and we want to even incur liabilities, and even if we're paying liabilities, we're doing that with the anticipation that one day it will somehow directly or indirectly improve the future cash flows. And so that's why we use accrual basis, because it makes for higher predictability instead of intentionally misstating your financial statements based upon when you decide that you're going to pay certain liabilities. Also missed quite a bit was item number 4, just one of the true-false, but probably half of the individuals missed this question. The first part of this is true, recognizes revenue when the performance obligation is satisfied, but the second part, expenses when cash is paid. This kind of goes back to question 1. You want to make sure that you're staying full accrual basis, so you're going to recognize expenses when they're incurred. Question number 11 was asking you to demonstrate your knowledge of two things: how a trial balance works and your understanding of how retained earnings is rolled forward. So if we take a look at this statement, our trial balance in front of us, the retained earnings as of January 1st, 2014, that is your beginning of year retained earnings number. That has all the cumulative profits and losses to date through January 1st, 2014. Your net income is going to be the net of the following three numbers of your net sales, your costing expenses, and your income tax expenses. So you would add to the retained earnings beginning balance the net of those numbers, and then you need to subtract out the dividends declared. The moment the board declares dividends, they become a payable regardless of when they're actually paid. Just like if you had received an invoice from a vendor on net 30 terms. Even though they're not payable that day, that doesn't mean that they are not incurred, so it's still a liability that'll show up as accounts payable that day. You just aren't dispersing the funds in that particular day. If you work this problem correctly, you would get an answer of approximately $4.601 million. Question number 12 was also missed quite a bit. This was looking for you to demonstrate your knowledge of the difference between the valuation or the allowance for doubtful accounts based upon the accounts receivable method versus the sales method. Now it gives you a projection of 4% of accounts receivable. So that means you're going to use a balance sheet amount or the accounts receivable to base your calculation. When you use a balance sheet calculation, just like the balance sheet is a snapshot, you're doing the same thing for the allowance for doubtful accounts. So you simply take the $750,000 times 4% to arrive at $30,000. Because it's the balance sheet method, you're calculating the ending balance, not the amount that should go into expense. So in this case, the ending balance should be $30,000. So regardless of what this problem told us the allowance for doubtful accounts was, it could say $100 billion, and your answer would still be D, $30,000. Item number 15 was a particular fun for all of us. This one is looking for us to demonstrate the difference in knowledge of different costs to be capitalized or not to be capitalized or appropriately accounted for. The answer to this one is D. We can arrive at the value of the building very easily by adding the construction costs of 1.34 million and the architect's fees of 35,000. The challenge is the land cost. We know that the demolition of an old building or raising a building of 20,000 goes into the land costs. Legal fees goes into the land costs, and the actual cost of the parcel of land for 280,000. Now you arrive at 305,000 with that. We must remember to take into account the value of the materials once we raised the building and we sold it. So it's only the net amount that we effectively lost based upon the demolition of the old building to arrive at the $295,000 in item D. Question number 18 uses Callahan Auto Parts from the movie Tommy Boy to illustrate an accelerated depreciation method. We have a particular asset with a cost of $120,000. It will be depreciated over 4 years using double declining. It's asking us not for 2014, but what the 2015 depreciation expense will be. We have to remember for any kind of accelerated declining balance, whether it's double declining or 150% declining balance, that we don't consider the salvage value in that case, with the exception that that's our stop loss. That's the point where we no longer depreciate. So if we take 120,000 and divide it by 4, we arrive at 30,000 a year if it was straight line, but it's double declining, so it's going to be 60,000 for the first year of depreciation. But that's not the question. So there's already 60,000 in depreciation. An accelerated basis uses the book value. So the book value now is 60,000, still divide by 4 years. So we would take the 60,000 divided by 4 to get $15,000. Since it's accelerated, we again double the amount. So we have depreciation expense in the second year of 30,000. So that means over the course of 2 years, we have depreciated this one piece of equipment by $90,000. But the answer here is 30,000 for the second year of depreciation. I believe item 22 felt like a trick question to some of us because it seemed like it was actually asking about franchise accounting when in fact it was only talking about accrual accounting or general accounting, because no matter what the question about revenue was, the answer to this item, no matter the industry, would have been the same, regardless whether it's a franchise agreement or some other type of agreement. The best way to approach this question is through a process of elimination. So let's work from item D. It can't be only after revenue has been collected, because certainly there are times when something is due to us. We perform the service in any industry, and people owe us for that service. In this case, we may have assisted them opening a restaurant, so we've earned the franchise fee, and it's collectible. So it's not going to be item D. Item C is not our answer either, because a franchise agreement can't spell out GAAP. So no matter what the franchise agreement says, if it's not generally accepted accounting principles, basically we get to ignore the franchise agreement and record revenue the way it's supposed to be recorded. Item B, when revenue is received. Well, that's not our answer because, frankly, that's just cash basis. So actually our answer is going to be A. Now we move on to our problem. There's a few items that I'll note about this problem. The solution will be posted online, but we'll talk about a few specific things that will help you with that solution. First, we received a 12/31/13 trial balance. This isn't the first time we've received opening balances in a company that already existed. The first thing that you need to do is to close out all your nominal accounts. Sales and expenses do not carry forward year over year. So you see a number that shows 0 retained earnings. That doesn't mean the 12/31/13 retained earnings were 0. it means that the retained earnings at the beginning of 12/31/13, so basically January 1st, 2013, was zero. So perhaps it was a company that started in 2013. So when we consider cash flows, the financial statements, all that good stuff, we're only going to consider those transactions that either A, were from real accounts that changed balances that carried forward, or nominal balances, which would relate to your P&L items for 2014. So you can't add together the 2013 and 2014 sales. Those go away. Those close out at the end of every period, but they're necessary for you to determine what the retained earnings are coming forward from that prior period. We are also given some specific facts. We'll need to know these facts because balances are carrying forward. So we're told the number of shares of Apple stock, but the most important thing with investments is that they're available for sale, so we know to expect some other comprehensive income if there's any change whatsoever in the value of that security. We're also told the inventory value that they use, not the value, but the costing method for average cost. And we already know the inventory value coming forward based on the opening balance sheet, and we know the number of lamps. We're not going to use the price per unit coming forward because we're using average cost when we calculate our cost of sales for 2014, but we'll need that information in order to calculate the ending price per unit to use. We're also told that the building was acquired last year and that there's a double declining balance on a 25-year life. That means the depreciation expense for 2013 is not going to be the same depreciation expense for 2014. We're going to have to use the net book value divided by 25 times 2 in order to come up with the current year depreciation expense. We're told information about the notes payable, and they began making payments or made one payment on July 1st, 2014. And we're told to assume that they are making payments on the interest as noted. So we will have some reduction in the notes payable, which means if it's on July 1st, there's going to be a different calculation of the interest expense. It won't be $3,000 for half a year. It'll end up being $2,700 because we have $90,000 in our last period of accrued interest payable. And then finally, because we want earnings per share calculation, we know the number of shares of common stock outstanding. And it doesn't change throughout the year, as you'll see in the problem, so we already know our weighted average common shares outstanding based upon that information. So let's go through the first few transactions. CUL purchases and receives certain inventory for a total of $146,000. Now that is your total. You have to make sure to read and see that that's your total. So the most you could possibly record inventory at is $146,000. Unfortunately, there is a late fee on that invoice. Now the late fee has nothing to do with the use of that asset. So you actually should be recording, and many of you caught, that you should be recording inventory at $145,000, and the $1,000 is an unrelated other expense. On the following transaction, we're selling lamps for a certain amount. Now it's on 2/10 net 30, but you need to read when the items were shipped. The shipping date is what will dictate whether or not they can take the discount. It has nothing to do with when the order was placed. So take a look at that shipping date, because otherwise there's no legal liability to be paid on that item. Then on the following item it says a payment date that specifically relates to B above. So if you noticed the shipping date and gave them the discount, you were good to go. If you didn't give them the discount, that's why you missed that particular item, because it's the difference between March 8th and March 1st. And of course, then we also paid $4,000 of our outstanding receivables from the prior year. It gave you the specific number. That's just a credit and debit relating to cash and accounts receivable, respectively. Item D had to do with a typical accounts receivable and voucher payment. So we had certain invoices we received. We're going to have to record accounts payable for $14,000. It tells us in the same breath, or the same item, that we're also going to pay down half of the 2013 payables. So we're going to pay half of the 62,000 or 31,000. The phrase trade payable is synonymous with accounts payable. It differentiates between a trade payable and every other type of payable. So a trade payable is what you have every single day. It's not a related party, it's not interest. It could be interest if they chose to record it that way, but a trade payable has anything to do that's payable under the normal course of business. On the following item, we're selling certain lamps under certain terms, and we're going to find out in this case we never collect the money. So if you record it on the gross method, it'll be a lot easier for this particular item. And then finally, on the following item, there's a certificate of deposit purchased with an original maturity of 90 days or less. This is a cash equivalent, it's not an investment. So you should change your cash to cash and cash equivalents and then group that particular amount with the cash balance. And now we finally get to our shares of Apple that are now unfortunately only worth $22,000. They were worth $25,000. So we should expect other comprehensive income at the bottom of our income statement or statement of operations, and it's going to be an actual other comprehensive loss of $3,000. We had a balance coming forward, so we're still going to have a positive balance of $2,000 of accumulated other comprehensive income in the equity section of our balance sheet. On the following item, CUL estimates 8% of accounts receivable is uncollectible, so we do a simple calculation of 8% times the ending AR balance to arrive at what our new allowance for doubtful accounts balance should be. So the difference between the balance coming forward from 2013 and our ending balance is going to be the amount of expense that we recognize. Let's take a look at just a few items on the statement of operations. First, we'll see that sales are $302,000. That means we took the discount on our first sale and we didn't take the discount on our second sale. You'll see that depreciation expense wasn't $10,000, it was $9,200 based upon the new net book value of the building, the $115,000 divided by 25 times 2. You'll also see that bad debt expense is not 8% of AR, it's the difference between the 8% of AR and the balance coming forward. I threw in the penalties and interest in other expense and put that below my operating line. You weren't required to, but that's where I would have put it since it's a penalty and it's not an operating item in most years. I also put down the interest expense. Now remember we had a July 1st, 2014 payment, so the amount of interest on that payment would be reduced a little bit. So it would be 90,000 times 6% times half of a year. So the 90,000 times 6% is 5,400. Half of that amount is 2,700. So the amount of interest expense for the full year is the 3,000 plus the 2,700. We did have our other comprehensive income or loss, if I labeled it more appropriately, but it still reduces the balance to the appropriate amount for the end of the year and for the statement. The statement of retained earnings was hopefully a lot simpler. You did have to remember to accumulate everything into your beginning retained earnings balance related to last year's profit or loss. It was a profit last year of $142,000. We add the current year net income based upon our calculations on the prior page. We didn't pay any dividends, so we arrive at our new retained earnings balance for the end of the year of the $277,000. The balance sheet had quite a few items of note. The first item, and most frequently missed, was the cash and cash equivalents, remembering that the 90 days of maturity or less is a cash equivalent, and so it is grouped with cash and just changes the nomenclature just a bit. The next most frequently missed item was actually just remembering to put net after billing. You have to show if there's accumulated depreciation, you have to show that that balance is being reduced. We also had the interest payable not everyone paid down the interest throughout the year based upon the instructions that the payments would be made, and we could make that assumption. And then some individuals missed that the note payable was actually reduced. So we went straight to the transactions and forgot to read some of the facts. But we were allowed to assume that the payments were made. Finally, the statement of cash flows, everyone's favorite. There's still a little misunderstanding that you need to make sure you're only accounting for those transactions that occurred during the period. You need to remember that the first line will be net income. Sometimes, if it's the first year in operations, net income and retained earnings are synonymous, but they're not synonymous in nomenclature. If you have a financial statement reader, they're not going to understand why retained earnings, a balance sheet account, a snapshot account, is placed on your statement of cash flows. So the first line is always going to be net income. Then you're going to have depreciation and bad debt expense. I didn't count off very much. Actually, I literally counted off only 1 point if these were out of order. You do have to remember that you use those items first that reconcile the net income and then the balance sheet items. So depreciation and bad debt expense are found on the income statement, and so those typically would be the first two items. Then you follow through with the changes in the balance sheet items year over year for those items that would be considered non-cash changes to reconcile operating cash flows. We didn't have any investing activities, and that's because I had a cash equivalent in the CD. If the CD had a maturity longer than 3 months, you would have placed the CD there and our cash balance would have been $10,000 less. And finally, we did have one note payment of $10,000. You do have to remember to slap all the labels on there for anything that did need a label. If there weren't any investing activities, no problem if you didn't put total investing activities. And you do have to put in your beginning cash balance to make sure that you are able to roll it forward to this year's ending cash balance. Now, some of you will be asking this question. You said I could get 2 points by watching this video. I did. So here's what you need to do in order to get 2 points added onto your final grade. And for a handful of individuals, that will actually make a difference in your final grade between which letter grade you receive. So if you email me a blank email with just the subject line Red Dragon, that's right, Red Dragon, REDDRAGON. Almost couldn't spell it there for a moment. But if I receive an email from you in the next 24 hours before I post grades online in the UTD portal, then you will receive 2 additional points on your final average for the class. I've absolutely enjoyed teaching this class these last 11 weeks. Do not hesitate to email me any questions about these financial statements, about any of the content in the course, or if you have any questions professionally. Until next time.